Hey everyone, and welcome back to another interesting video. Well, hopefully interesting video, although the stock we're going to talk about today is in an industry that might not interest most of you. It's in the banking finance industry. Stock is up over 50% year to date, so that's already quite something. But the business itself is performing better and should be performing even better in a lower interest rate environment. So what's the company? What do they do? How are they performing? Let's go over all of that in this video. Like, subscribe, do all of that. Would really appreciate it. And if you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So I'm talking here about Evercore, ticker symbol EVR. So this is an independent investment banking advisory firm. It operates in the United States, Europe, Latin America, and internationally. There are two segments to its business: investment banking and investment management. Now, investment management, there are strategic advisory, capital markets advisory, research, sales, and trading. In investment management, wealth management, and asset management for institutional investors. Now, last quarter, we've got some comments here from the CEO and the founder and senior chairman. We are in the midst of a gradual market recovery, and we continue to be encouraged as momentum builds across many of our businesses. We provide a broader range of products that we ever have before to a larger, more diverse set of clients, presenting significant opportunity for Evercore. Evercore produced the strongest second quarter net revenues in our history. This reflects the consistent expansion in the number of SMDs, senior managing directors, which is continuing. Now, why are they going to perform even better in a lower rate environment? Well, a couple of points here I wrote down. One, increased M&A activities. So lower rates make borrowing cheaper, encouraging mergers and acquisitions. But what might also increase M&A activity is, of course, a change in administration or a change in stance from the FTC, because, well, M&A, let's face it, has been a bit low in recent years. Second, high valuations. Companies are valued more, making them more likely to consider M&A deals. Third, increased demand for advisory services. Companies may need restructuring or refinancing, increasing demand for Evercore's expertise. The last one here, investors seek higher yielding investments, benefiting Evercore's wealth management division. Now, this is basically the business profile. So gross profit margin of 93.82%, net profit margin of 11.22%, revenue per share 68.78%, EPS diluted $7.24, PE ratio of 35.37, a forward PE of 21.9, a dividend yield of 1.31%, but they're buying back some shares, so the shareholder yield is a bit higher than that. Now, last quarter, these were the numbers. So record net revenue of $695 million, that's up 38% year over year. Advisory fees increased 52% year over year to $568 million. Underwriting fees are down 19% year over year, but up 42% year to date. European advisory business showed improvement with a growing backlog. Wealth management asset under management reached a new quarterly record of over $13 billion. Compensation ratio is at 66% for the quarter. And there is positive outlook for market recovery through 2024 and into 2025. Now, especially with the rate cuts, things should be looking even better. Now, if you want, this is also, of course, a solid dividend pay. I mean, as you can see, in the last 9 years or so, dividends have gone up by around 4x. So not too bad, I would say. Now, I do want to show you a couple of things here with regards to its business and why it has been performing very well this year, but did not perform well beforehand. So you can see here from Q1 of 2020, which was, of course, around the period the pandemic has started, you can see that since then, revenue is up, that's in the trailing 12 months, is up around 30%, free cash flow is up around 5.76%. But you can see the year-over-year increases. So from Q1 2020 up until Q3 2021, things were going very, very well. Then we see the year-over-year increases, decrease, and it went actually into the negative up until here, Q2 2023. Then we see some reacceleration in growth, although still negative, but you can see that revenue has bottomed out, and actually in the last quarter, it was back into the positive. free cash flow has reaccelerated again, and so the stock reacted positively. As I've mentioned before, gross profit margin around 93.8%, net profit margin around 11.2%. And yes, of course, it was much higher when revenue was higher, when free cash flow was higher as well. I don't think we're going to get back to those numbers because this was just a crazy, crazy period. But could we get back to the 12, 13, 14% range? I think we could. I think this company is also has become a stronger company as well. So we could see these net profit margin go back up to 13, 14%. Now, right now, it's definitely not the cheapest one out there. Has a forward P of 21.8 times. It's higher than its 5-year mean of 13.7 times. Price to sales 3.1 times. Price to free cash flow 13.7 times. But as you can see, price earnings to growth right now, 0.53. Why is that? Well, if you look at the analyst estimates for sales growth, in fiscal 2024, sales is expected to grow 18.6% year over year, followed by 21.34% in fiscal 2025, and then followed by another 14.22% in fiscal 2026. So top line is growing, let's say, fast. Not super fast, but it's growing fast. EPS is growing much faster. So EPS is expected to grow close to 50% in fiscal 24 and fiscal 2025, followed by another 19.5% in fiscal 2026. So yeah, I mean, it's true. Forward PE is higher than before, but the growth rates are higher than before as well. So I do think it deserves this type of small premium. Now, as I did in previous videos, and I think most of you like these types of things, a quick reverse DCF here. So Evercore free cash flow trailing 12 months sits at around $715 million. I put here a terminal growth rate of 2%, a discount rate of 9%. You can do 10%, you can do 8% because risk-wise, I think 9-10% should be good. So to justify today's price, it has to grow 1.2% in the next 10 years, free cash flow-wise. That's the implied growth rate. 1.2%. We've just seen how fast it's expected to grow in fiscal 24, 25, and 26. I mean, of course, growth will decelerate, but this is just 1.2%. Not that much. Let's say it will grow, let's say we put here 7%. Not even close to what we've seen before, right? Just 7%. 7%, and let's do a discount rate of 10%. You can see here 25.4% upside for this business right now, which should definitely see some tailwinds in the coming quarters, maybe even the coming years as well, as interest rates come down. So that's basically why I wanted to show you this company. The next video is also going to be about a company that actually you're going to see here 0%. Yes, priced for 0% growth, even though it is growing. So yeah, again, it might not interest a lot of you. Evercore, banking, finance, stuff like that might not be interesting, but you're getting a company that is paying a dividend, that is growing, that seems to be a little bit undervalued, buyback shares as well. So yeah, I mean, let me know what you think down in the comment section below. You can actually see this right here. In the last 5 years, shares outstanding have come down by 3.85%. And the stock has gone up by 217%. So, yeah. I mean, it's true that SBC as a percentage of revenue, because of the type of business that they are, is quite high. We've also seen the compensation ratio. It's quite high. But, yeah, overall, I think there is value if this is an interesting industry, an interesting stock. If you're looking for a dividend-paying company in your portfolio, I think this might be one that you would like to look into. Do share your thoughts down in the comment section below, like, subscribe, do all of that, and I'll see you all in the next one. Bye bye.